Okay guys, we're going to be discussing entry and exit strategies. Now, this is just as important as the actual strategies that you use in terms of your setups and why you're taking a trade on in a certain area, what you're looking to do, how you enter it, the way in which you enter a trade, the planning of your execution, what you expect to see and where you expect to get in, how you expect the trade to happen is just as important as the actual trade idea itself. Because ultimately this is where you gain a huge amount of edge. This is where trades can move from being a high value trade to a very low value trade very, very quickly. So we're going to cover this. We're going to look at various different strategies, but also looking at how your style affects what you're doing, how your style impacts the strategy that you're trading. So we're going to cover all of that. So without further ado, let's get on with it. Let's go and have a look at entry and exits. Now, first thing, like I just said, your trading style is crucial. And it's crucial in understanding what exactly you're trying to do, how you're going to enter trades. So I'm going to try and break these down into perhaps the three main styles that most of our traders use, the three main styles that probably realistically most traders, day traders use on a whole. And try and distinguish how we try and look at these and how these affect the way that you take trades on. Now, the first thing that I think is synonymous with day trading is scalping. This is what people usually think, oh yeah, day traders, they all scalp. This is what they're doing. Now, this still happens, absolutely, but scalping is more than what it used to be. When I first started off, 2007, 2008, scalping was all about nicking ticks. It was trying to make one tick here, another tick here, another tick here, click, 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 using the order flow to try and nick little inefficiencies out of the market. That side of scalping has diminished significantly over the last few years as markets are more efficient, there's greater market making, there are more algos. It doesn't mean that this is a dead skill and something that can no longer be done, but it means that the way you do it has perhaps slightly shifted. And the way that you enter a scalp trade, exit a scalp trade, has changed in its perspective and changed in what you're trying to do. Nowadays, a scalp trade is more about taking a trade from point to point. That would be how I view a scalp trade, that you're taking a move from, say, a level up to the next available reference point. So this could mean that a scalp trade may well be 2-3 ticks. Realistically, it could be more like 5 ticks, 10 ticks, in some instances 20 ticks. And that's going to vary with volatility as well. So scalp trades now are more about taking what I refer to as the clean move. The move from here to here, that you can say there is nothing in between those 2 points that necessarily is going to get in my way. That's the bit that I'm looking for when I'm considering a scalp type trade. Now, the key bit with a scalp is about accuracy. I think because of the natural tendency to assume that scalping is high frequency from a point and click trader's perspective, lots and lots of trades, that there's a kind of scattergun approach to trades and that you take trades on very quick, which implies that you take trades on at market. But scalping is so much about trying to get your entries and exits just right. Think about the scenario where you're looking to take a 5-tick move out of the market. If you're looking for 5 ticks, if you give away a tick on your entry by deciding you're not going to wait to get filled on the bid, but instead you're going to just hit market, if that's your intention, that's the way you try and take the trade on, you've effectively given up 20% of your trade. And if you do the same on the other side, you've given up 20% there as well. That all of a sudden is a very, very significant amount, and that can be the difference between your strategy actually having any kind of outright edge or not. So your entry is so crucial. Now, it's not to say that you don't hit market when scalping, but it's to say that you need to understand exactly what that scalp is. When we do a bit more on order flow and look at different types of scalps, because not every trade that tries to take 2 or 3 ticks out of a market is taken on in exactly the same way. So scalps can vary. You need to understand what different types of scalps you're trying to take on. We're going to cover this as we move into order flows, and this is not something that we're going to be covering off in this session. The aim of scalping is all about high frequency of trades. This takes advantage of a small edge. Now, a small edge doesn't pay you very well, but taken multiple times with a minimal risk can pay you very well over the long run. And that's what you have to remember with scalping. For many, they look at scalping and see it as a situation where you've got a pretty low risk reward. You might be taking trades that are potentially a 1-to-1 risk reward. You're going to risk 3 ticks to make 3 ticks. And many traders look at that and think, that's not right. And that's not something that you want to be engaging in. But as we'll look at more and more as we go through, there's more to trades than just the risk reward, and it's as much about the probability of that trade working as it is the risk reward within the trade. A 1-to-1 risk reward trade if it has a 60% win rate, is a good trade to be taking on. And you're taking advantage by taking that trade multiple times. You're taking advantage of that small edge, that small 10% gain. You can even take a trade that risks 6 to make 3, as long as when that wins, or the win rate on the trade is high enough. If you're making 3, 8 times out of 10, then for every 10 trades, you're going to make 24 ticks. And 2 of those trades will lose and lose you 12. So you're going to make 12 ticks for every 10 trades. That's still not a bad trade to be taking on, as long as that win rate remains consistent. And so it's about taking advantage of a small edge whilst not taking on large individual risk on any one trade in particular. Ultimately, to use a footballing analogy, it's about trying to become top goal scorer and not winning goal of the season. Like I said, trades do run point to point. That's what you're trying to do. You're trying to go from this point to this point, boom. You're done. You get in, you get out, trade is done. And you're not looking for anything more than that. This does naturally mean that you are going to miss out occasionally on a move where you buy here, and in fact, you bought the low of the day and you watch the market go. This is something you have to maintain in your mind if you are going down a scalping route, or you view a trade as a scalp. That's the trade. This is the purpose of the trade here. What happens afterwards, you never thought of doing and you weren't looking to do. That's crucial. And if you're looking for a scalp trade, the ability to go, right, once I've done the trade, that trade is done, we move on to the next trade, is crucial. Otherwise, there's a constant temptation to think, this might be the one where I bought the low, and try and hold and hold and hold a trade. That's going to skew the value of that strategy over time, because there'll be many trades that work perfectly as a scalp that you end up taking losses on unnecessarily, and skewing that already small edge that you have on trade by trying to sort of change a scalp into a swing trade, for example, is going to be very detrimental over the long term. One of the hardest things with scalping is to understand when you actually have an edge, because you can scalp every day. You know, you come in, if you're looking for moves that go from point to point, there are trades every single day. But some days, those trades become fudged. Market will wash around levels. It won't trade cleanly from point to point. Some days, certain types of scalps that you look for aren't plausible trades. If you're someone who scalps with trend, for example, or scalps counter trend, certain days are not going to suit that style. As such, one of the most important things, if you're learning how to scalp, is trying to define what days produce the greatest opportunities. What days does your edge, your scalping edge, actually show itself? Ultimately, this is going to become an element of a P&L basis of judgment, and you have to look at, if you're using a scalping type strategy day in, day out, what was going on any one day that might be able to say, well, that was good and this was bad. So you can try and differentiate days and say, okay, this day has the characteristics of being a good day for scalping, for example. That's what you're trying to do. That's one of the hardest bits, and one of the things that ultimately, from a scalping perspective, is one of the few things that you can kind of track and define over time. Okay, swing trades. Now, I think this is, again, something where, and I would try and describe it from our perspective of a swing trade. Many people see a swing trade as something that's going to last days, and that is the traditional kind of explanation of a swing trade. Somewhere that you're trying to take the next big move out of the market. But this doesn't have to be the case, and a swing trade can be done on an intraday basis. A swing trade to me is a trade simply where what you're trying to do is you're trying to capture a directional change. So you're looking at a move that, say, goes down, and you're trying to get on the swing back up, for example. That to me is the way that us as day traders see a swing trade. So this can naturally be something that would happen on an intraday basis. Of course, it may only happen once, twice a day. You're only going to get 1 or 2 turning points within a day. But they're the trades that you can look for. Now, if you're taking on a swing trade, what is so crucial here is your entry. And more to the point, ensuring that you get the entry. Because you're not going to get many swing trades. Like I say, you may only have 1 or 2 in a day. So if you don't get onto that trade, you're now leaving yourself missing out on that potential opportunity. Whereas you will always get on the ones that go wrong. Just for anyone wondering what I mean by that. If your intention is to buy here, because you think the market, you're going to say, right, this is a swing trade, down we go, up we go, and I'm going to buy on the level. If you don't get filled, you miss out on this. But if the trade doesn't work and goes and breaks the level, you will always be filled when it goes wrong. because to get to your stop, it has to fill you. It has to go through the level. So this is why it's so crucial to make sure if you're on a swing trade, which naturally do not come around very often, that you make sure you get in. Otherwise, you end up skewing your win rate because you will take it every time that it goes wrong. But if you miss 50% of the winners, all of a sudden, these winners have to have a very significant payout to justify the cost of taking the loss every single time that it happens. Now I talked about actually trying to play the reversal or play that swing type move. Now the other side of a swing trade is about not getting the low, and that's why you're not sitting there thinking, right, I'm going to play at this level up to here. The aim is to define when the turn has come and then play the move. So your job as a trader is not to pinpoint the high and the low. That's the job for people who want to ego trade, who want to be able to brag about how they got the high and the low. Realistically, nobody can consistently do that. In which case, it's luck if you get the high or the low of the day, and that is all it is. Your job is to define whether the move has finished. So whether this move down has ended. And once it has, now you can play the swing trade back up. And so once this move's ended, realistically, rather than buying it here, you're looking to buy it somewhere here to play this move. That's the bit that you're after with a swing trade. You want to define that the move is over so that you can confidently play this. Now, of course, this does imply that your risk is still going to be down here. So you do have a higher risk on trade, but you're also looking at a trade that gets a greater deal of confirmation. Unlike a scalp trade may well be to try and play it from the level back to the first point that it stalls at. But here, what you're trying to do is you're trying to capture this move, perhaps all the way back up here. So yes, you may have a risk of X, but you've got a payout of Y, which equals 3X, for example, potentially 4X, 5X even. And so what you're looking for is you're looking for a high payout on trades. Your win rate may not be great on something like this, and the win rate's not so important as with scalping. Because the risk to reward is very even with scalping, you need that decent win rate. With a swing trade, it's about capturing and holding the moves when they actually work. And so realistically, I put 3X, you might be looking for say 8 times your risk on a trade. And it's okay if you don't get these very often, because the payout is worth it when it comes. This, like I say, is different to the winning top goal scorer. This is going for if there was a prize or a greater payout for scoring goal of the season, this is what that is. This is what you're looking for. The bit that is often tricky for many traders with a swing type trade, and this is something that I discovered early on, that I thought very much, this is my style, this is what I'm going to do. But what is often very tricky is that you will sit through periods of uncertainty with a swing trade. Now, of course, you do to a degree with a scalp trade. But with a scalp trade, you are given a point to get in and shown a point to get out. And once you move from one to the other, the only uncertainty is whether it will get to the other point. With a swing trade, however, you have something different. If you've got in this example, somewhere in this range, you are offered a chance to exit at the top of the range. Plausible exit. If you brought it down towards the lower range, you could get out of the top, and as a scalp, that's a reasonable trade. But you have to sit through this and accept that we could trade here multiple times, and you cannot get out of this trade. Because if you get out, you've taken a very small winner, just in here, I'll get rid of that bit. You've taken a very small winner, but risked this. So now all of a sudden, your winner is significantly lower than the amount of risk that you've taken on. So all of a sudden, Z, if you will, to use an algebraic term, Z is going to equal maybe 1/4 X. So all of a sudden, now, you've not only taken on a trade that may have a low win rate, but you've got paid a quarter of what you're really willing to risk on the trade. This is why you've got to be willing to sit through that uncertainty, to see the market put you onside back, onside back, onside back. And you can only have conviction on this trade once you break through here. And then maybe you can have conviction. But even then, there may well be larger swings within the trade as the move goes on. This is something that you have to work out for yourself, whether you are comfortable to deal with that, whether you are happy to see a trade that perhaps moves you 30, 40 ticks on side and gives it all back, because ultimately your goal is to look for 100. And giving up after 30, to go back to the sort of scalping comparison, giving up after 30 ticks when you're looking for 100 is the same as paying up a tick on a scalp, paying the spread effectively and giving up a significant portion of your trade. So you have to bear that in mind. And it is a case of you're making that judgment for yourself as to what it is that you're more comfortable doing, what you're more able to do as a trade. So you will end up seeing unrealized profit disappear. You could end up seeing quite a significant amount of money disappear, because ultimately your goal on a swing trade is not to take that significant amount. You're aiming to take a much more significant amount. Right. The other style, which is perhaps something that a lot of traders outside of the prop industry stay away from, and this is the risk or event style trading. So the idea here is looking at events, data events, risky events, or high volatility news events as an opportunity. Now, what's so crucial about this style is your ability to go from 0 to 100. This is a style that naturally does not imply large amounts of participation. You're not going to be in the market all day. You're not going to be trading very frequently, necessarily. Your job is to make sure that you're aware of narrative, that you know where the opportunities lie, and you know what a change in the current narrative implies. You know what that means in terms of trade opportunity. And you have a clear plan as to what markets you're going to execute and how you're going to execute trades. So you do have what I would call a semi-automated strategy. Now, that doesn't mean it's programmed in a computer, but you have a very clear plan as to exactly what you're going to do in a certain situation. If this news happens, you will do this, this, and this. If this news happens, you will do that, that, and that. So there's a very clear process and plan as to what you're going to do in various different scenarios. One of the most key bits to this as well, which is again another area where people feel quite uncomfortable, is that you have to, from a position of not really trading, of not taking on a great deal of trade, move to being extremely aggressive and reacting very, very quickly. So you've got to be willing to be doing very little to full size on a trade immediately. And there's reason for this. The move that you're trying to capture is generally going to be very fast. The move that you're trying to capture also will have lots of other participants suddenly reacting as well. And this is where a move becomes erratic, volatile, and dangerous. And this is why people generally view these types of events as something they don't want to trade, because they view it as that. It's erratic and volatile and dangerous, and therefore they don't want to trade. But if you have a clear process to do it, clear process of trade management, then you can circumvent that. You're not going to change the volatility. You're not going to change the erratic nature of the market in those situations, but you are going to change the amount of danger. And this is a really key, crucial fact to sort of bear in mind. The other aspect of a trade like this is the infrequency of trades, which does mean that you have to consider these trades over time, not in an individual basis. Because when a trade like this goes wrong, it could cost you your day. That's the whole day gone. All of your risk, you stop out for the day. And you have to sit with that. And you have to then be willing to come back the next day and, presented with a very, very similar situation, still be willing to take it on in the same way. That's a hard thing to sort of hold on to over time. You have to view these types of trades as something that is going to pay you in the long run, not in the short run. Take, for example, if you're going to trade non-farm payrolls every month, there's 12 iterations of that a year. Now, at the end of the year, you may well have been profitable on 9 of those 12. But out of the first 3, you may have only profited on 1. So you have to sit for the first quarter knowing that you're actually down. And that's something that can be quite difficult to hold on to. And you've got to view your performance over the long run, trade by trade, which, because of the gaps between opportunities, does mean that you have to kind of sit with and maintain the conviction that this style will pay you in the long run. The other side of it, and we'll talk a bit more about this when we do risk management, going back to the aggression and the reaction speed. If a market is suddenly going to go from moving like this to do that, but this move is likely to be very fast and very erratic. One of the biggest dangers in a move like this, and the easy temptation, and this is where having a clear plan and process comes in, and and we'll do more on this when we do macro trading, is that if you can get in down here towards the low of the move, this is the point where you need to have the biggest size on your trade. Because once the move starts and gets going, this is where people who have got in early start to take their profit and create this wash down. People who have got in late become trapped and also contribute to the pullback. And then the market will wash around as people try and jump in, jump out, jump in, jump out. People get caught up. There will be some people who are buying it up here and are now offside and panicking, and they now start to sell to scratch up here. This is where it becomes erratic. And for that reason, this is why you need the most size on as fast as you possibly can. The temptation is always to put a trade on here and add as the trade goes on side. But that's going to cause you a lot of problem. This is something that I learned to my detriment. There was a Fed decision. This was the first taper, in fact. So this was September 2013. And what happened, I think it was September, the Fed basically said, or the expectation was they were going to taper at that meeting. So going into the meeting, you're thinking, okay, the one big scenario here is the Fed doesn't taper and the S&P is going to rally. And what happened is the Fed didn't taper. And so I thought, brilliant, this is the trade. Similar move to this. But what I did, and the mistake that I made, was when that news came out, I bought 20 S&P to here. So I'm 20 long. Market jumps, about 10 handles on side. This is good. This is what I was looking for. But that's not my full size. I'm looking at that thinking, I need more on this trade. So having seen the market jump, I then add 80 up here. So now I'm 100 long and my average price is here. This is the problem with not committing to it fully straight off. Because when it washes back, you're now in a very, very uncomfortable situation. You're in a move that is much more volatile, that is swinging 10 handles at a time. And you've got 100 lots on. This becomes a very, very uncomfortable situation. And so therefore, I ended up scratching the trade, only to watch the S&P continue for another 30 handles. And the reason that I ended up not taking what I should have done out of the trade was not because the trade was wrong, or because my idea was wrong, or even because my execution here was wrong. The problem was the size that I executed here, or doing this. So you have to be able to say to yourself, right, if I'm not putting it all on here, I can't add on to it. So either you put the 20 on and you accept it, a 20 lot in the S&P for 40 handles is still a pretty decent trade. But by putting the full size on, which is ultimately what I wanted, I ended up giving myself nothing. And realistically, it should have been 100 for 40 handles, which is $200,000. And that's the lesson there. Yeah, and that's a really important point, and one of the lessons that we spent a lot of time on, and the best guys in the business, in this office, doing it, are exceptionally good at that being willing to put it all on early on, and that's a key skill to learn. It's only something that I'm never forgetting. Right then, the other important thing with your entry and exit is the style in which you're going to take the trade on, and understanding what it is that you need to be doing. Now, there are going to be some styles of entry and some styles of exit that you're not necessarily comfortable with, and that's fine. You don't have to enter in that way, but you need to understand what it is that you need to see to enter a trade. And one of the most important things is that when you reach a point to enter a trade, you need to know exactly what you're going to do at that point. It's not a case of, and I've talked about this earlier already, it's not a case of getting there and thinking, I might not buy it. I'll buy it if it's going to go up and I'll sell it if it's going to go down, because you don't know that at that reference point. You need to make the decision clear. So your decision has to be, I'm going to use in this example, your decision has to be that you think this red level is going to break, you're buying it. That's the plan. So you're going to play for a breakout. This way, you've now made this decision simple. This is a binary decision. You are either going to buy it or you're not. You're not going to sell it. So I call you can't have your cake and eat it. You can't buy it and sell it. You can't buy it if it's going up and sell it if it's going down. You have to decide you're buying it. And then it's just a job of deciding, is now the right time to buy it? So it's the case of when it gets here, you've then got to say to yourself, okay, what do I need to see? And have a plan as to what you want to see here. If you don't get what you want, if there's not sufficient information, if there isn't enough buying as you approach the level, to give you a reason to enter the trade, you don't take the trade on. You step away and you go, okay, this trade's still there, it's still an opportunity, but it's not an opportunity right now. You've also got to plan how you intend on entering. For some, they may well want to buy it, but their intent is not to buy it on the break here. This is a trade where you're going to look for momentum. You need to see the market, the pace of buying accelerate. You want to see volume up, you want to see delta up, you want to see speed in the market. That's what you're after here, and you can enter, and you can buy it as it breaks through the level. But for others, they're perhaps not comfortable with that. Perhaps it's not their skill set to recognize that momentum shift. And that's something you can learn and you can teach yourself. For many people, and perhaps one of the more common things that people prefer to do, is what I would call a passive trade, a pullback. Now, ultimately, every trade falls into to one of two categories. It's either an aggressive trade, where you try and play it at market as the move happens, or it's a passive trade, where you wait for the move to happen, and then, after having been given confirmation, you then lay your bid to try and buy. Now, each of them have their ups and downs. With the passive idea, this is crucial still to understand that you have the right information, that you have the slowing down of selling. You need some selling to get it back here, but you want to see that slowing down. You want to see that selling running into buyers, joining you in that passive buying that prevents the market from dropping. Otherwise, you're going to sit in front of a train and the train is going to come along, run you straight over, and market falls back down. So there's still an element of understanding what you need to see here. With the momentum move, you run the risk of momentum running out at the point where you enter. You run the risk of misinterpreting the momentum or not getting quite enough, because with momentum, it's so much about being on the button as the move happens that it's easy to become inclined thinking, yeah, that's enough, to ensure that you don't miss the trade. Because the danger of a momentum trade is it's going to be too quick and you'll miss it. And if that happens, you're then equally stuck. And so the temptation there is to preemptively enter, or enter without enough momentum to try and counter the fact that you could miss it if there's too much. Conversely, any trade runs the same risk. Waiting for the pullback, it may not come, in which case you're going to have to adapt again from there. So it's about understanding what exactly you're looking for and how exactly you're going to try and take a trade on. If you've got both of these skills, then you have the opportunity to play this in two parts, or give yourself options. One of the greatest things you can give yourself in a trade is options as to how you take that trade on and what exactly you're going to do with it. What do I want to move on to now? Different methods to get into trades. Different ways to actually try and enter a trade, and what the upsides, downsides, and what you're trying to do, what you want to see when you're taking on a trade, why you're going to enter in a certain way. So, first up, scaling into positions. This is not averaging. And averaging is one of the biggest dangers to a trader. Averaging into a position ultimately is a situation where you have no idea where you're wrong. And the reason for averaging is to bring your average price lower if you're buying, higher if you're selling, in the hope that the market is going to put you back on side. This is one of the most dangerous things you can do. Because what ends up happening, or what you're doing essentially, is increasing risk at a point where you have the greatest amount of doubt and uncertainty about a trade. You never want that. The time to increase risk is when you have the greatest degree of conviction, when you feel the strongest probability that this trade is going to work. If your trade has gone offside and you're looking at it thinking, I don't like this, I'd better buy more, what you're doing is you're admitting that you're wrong, you're accepting that this doesn't look good, and rather than accepting that and getting out of that situation, you put more risk on that situation. That's not going to help. And that's ultimately a sign of desperation. And people will do this in the hope that things work out, in the hope that the trade comes back. And the danger in averaging is that occasionally it will come back. And if you average far enough, often it will come back. The problem is you will get away with that to a point. And there will be one day where it doesn't come back. And when it doesn't come back, that's career over. That's the problem with averaging, that you're one trade away from it all being over at any point. And that's never a situation you want to put yourself in. Stressful, it's dangerous, and ultimately it will happen at some point. So it becomes a fruitless endeavor, because at some point you will get caught out. It swings back on the old phrase from John Maynard Keynes that markets can remain irrational longer than you can remain liquid, i.e. things can go against you further than you think and you will run out of money before the irrationality stops. So that's the lesson on averaging. Now, scaling into a position is not quite the same. Scaling into a position, you know where your stop is. And what you're trying to do here is you're trying to define an area where you feel that the market is likely to stop, where you feel that you can enter a trade. This is perhaps more tilted towards a swing type style. As we talked about with support and resistance, levels often aren't one pinpoint. And so if you have a situation where you expect a market to be responsive to an area, you can then try and scale across that area. You may have 10 ticks that you're looking to enter within. And you can then split your orders up across those 10 ticks. This way, you can ensure getting filled and guarantee that you're in the trade. But it does run the risk, of course, that you are not necessarily going to get the optimal price, the greatest entry point. The other factor to this as well, which harks back to a swing type style, is if, say, you're zoned to scale in, you're looking for a market to move up into here and fall back, you can't exit the trade until at least you've fallen out of this zone. Because if you've not fallen out of there, in no way are you right yet. So you have to bear that in mind, that it could imply that you sit with an average price here, watching the market trade here. You're uncomfortably offside, but ultimately you're not wrong. The idea, like I say, is about guaranteeing position rather than waiting for the most accurate entry point. But there are downsides. One of the biggest downsides to this is that you may not get everything you want. If you've got a 10 tick range to try and get filled across, you get filled at the bottom of the range and the market reacts from the bottom of the range, you'll get filled part of your position. Now, like I said with swing trades, when it goes wrong though, it will trade all the way through the range and stop you out. Therefore, you will get filled on everything. So part of scaling in requires a plan as to how you're going to get this risk on. Because the way that you've got to think about risk is that you're willing to take that risk on all of that size, whatever amount it is, to be stopped out. Now, if the trade works, you also want to be paid on that risk as well. So to give you an example, if, for example, you're willing to risk 10 lots with a 10 tick stop, that's 100 ticks worth of risk you're taking on this trade. If you get filled on one lot and your target is, let's say, 30 ticks, you're going to get paid 30 ticks for 100 ticks worth of risk. Now, granted, if the trade works, you're never going to take that risk, you're never going to see that loss. So you make 30 ticks. But if that had gone wrong, it's going to cost you 100. So the risk essentially is already taken. So you need a plan so as to alleviate that issue. So that if you do not get filled on everything, you can at least increase the size as you move out of that zone to make sure that the risk you're taking matches the reward that you can gain. Otherwise, you run the problem of again taking the full loss when it goes wrong and not getting paid on the winner when it goes right. We're going to look at a couple of different versions of this. A version of what I call a swing type trade, a passive entry, but also something that most people don't associate with this type of style, an aggressive execution zone entry. And this is about building your trade up, building your size once you reach a zone, scaling into your position using the order flow within a certain area. So, this is your kind of traditional style, if you will. Traditional scaling in style. And what we're looking at here, simple trade, this is one in Euro stocks. Context matters, of course, and this is always the case. It's something I could say every time. What you're looking for here then is we've got a bearish market. Market's starting to fall. This is your profile, so we've not necessarily covered profile yet, but value is moving lower, we close lower, we open a little bit lower and trade down. That's this move in here. So you've got a bearish move, bearish start to the day. You know, and this is a bit like that delta reversal trade that I talked about, my one where I made a mistake. You know that you could sell somewhere between yesterday's low and the previous day's low. That gives you a little range between 18 and 27. Anywhere in there, all good. And you can place your stop just above 30 inside value, so that gives you a stop just up here. So in the worst case scenario, that's going to give you a stop of maybe 15 ticks or so. So you've defined your stop. You've defined the area that you can get in, and you can define your target. In this situation, because we have traded down and back up, you're perhaps looking somewhere more towards the kind of middle of range, somewhere back down here, around about the 90s area, something like that. So your aim then is to passively scale into this, and you have options as to how you do it. You could simply say, right, I have got X number of contracts I want to get in, and I'm going to place them every 2 ticks all the way up this range with my stop for all of them there. That's a simple method to do it. Alternatively, you could wait for the market to get up into this zone and execute using order flow. Use the way the market trades in the zone. You may well be able to actually skew your risk up here, get the majority of your trade on towards the top, meaning that in fact, you've now skewed your risk reward on the trade by giving yourself still a small risk because you know where your stop is, but a bigger payout. And as long as you get back below the previous day's low, back below 18, this trade looks good. And you could be in a situation where you're 6-7 ticks on side on the whole position before you even get back below 18. If you get back below 18, wonderful. You've got at least 6 or 7 ticks in the bag, and now you can look for the rest of the trade. So that's the idea behind a passive trade. It's about defining an area and being willing to sell anywhere within that zone rather than trying to define it to the point price. Now, how you decide to scale into that zone is going to be influenced by the way the market trades. So this is the trade from a bigger perspective. This is the preamble to the trade. So we've had this grind up, and this is what gives the very bearish perspective. Grind up, sideways range, market starts to drop, and we drop further. So we're breaking out of the previous range. And this is why this area is so significant. It's not just simply the last couple of days lows, but it's in fact the lows over the last month, in fact. So this is why this 43.18 area is so important. So what you can do then, as the market moves back up into it, this is the move on a 1 minute chart. This move here moves back in. So you know that you're intending on entering somewhere in this box. Now, like I say, you could scale across it. Alternatively, you could wait for more information. As soon as you get into this zone, you can then wait for volume to start to build up, giving you potentially, and this would be an absorption trade, so something that we can talk about a little bit more with order flow and perhaps bring this example up. Look at how this trades. You can trade that from an order flow perspective. As volume starts to build, as the market absorbs any buying, so buyers come in and sellers start to build up, you can actually end up getting your position filled all the way up here at around about 23 for the full position. This way, as you start to move back on side, now the move is confirmed. Now you can feel conviction that you're right, feel confident that you got the trade right, and now play it back down through the range. There's your 90s, there's your target achieved. You're taking on perhaps a 6-7 tick risk here, and you're able to extract around about a 30 to 35 tick winner. So around about 5-6 to 1 on that trade. That's what you're trying to do by scaling into that trade. You're saying to yourself, right, somewhere in this area I'm willing to get in, I know where my stop is, and then use either the way it trades in or simply scale it across that zone. If it traded there and started to come out, you may well have had to add on as you fall back away from 18 so as to maintain the size to get paid on as much as the size that you're taking on to take the risk on with as well. Right, pre-positioning and using what I call an execution zone. We're going to look at the order flow on this in a little while. Using an execution zone to get into a trade, and then we'll look at this in a little while as to how to actually add on to a trade as well. What we've got here then is a situation where you've got a couple of daily highs. These come in at around about 98.9, 99 area. So you're looking for a break above there and an acceleration higher. That's the idea behind the trade. On the day, you have a high that comes in at around about 96. So you now have a little zone between the current day's high at 96 and the breakout at 99. So a 30 tick range. This can be where, again, you can scale into the trade. As you get into this zone, this confirms the possibility of a breakout. As such, if you have continued volume building, if you have delta start rising in this zone, you now can start to add to your position. Build your position up here as you get more and more information that confirms you're right. It may well be that if you move into this zone and just dribble up, there's not a trade and you don't have to take it on. But if you get the right type of order flow, the right type of action once there, you can then scale your position in, build that position up. And as long as it's staying in the zone, you can place your stop below 96, waiting for the break and be pre-positioned before it breaks 99. So it's a case of being able to say, right, anywhere here is acceptable. I don't mind whether I'm buying 98, 96, 97, 96 and a half, it doesn't matter as long as I get the trade on before 99. That's the idea of an execution zone. What you're trying to do ultimately is try and maintain the lowest average price. So as the market pulls back within the zone, you try and buy there. That's ultimately what you're after. And we'll show you this in a moment. But the aim here is to scale in within this zone so that when it breaks out, you're already in the trade and then you get the run towards the upside. This gives you, excuse me, a further 70 to 80 ticks over the next 3 or 4 minutes. So that's the idea of scaling in. You're having an execution zone where you're willing to say to yourself, right, this is the area to get in. I'm taking all my risk here, because if it goes wrong, your stop is minimal, down at 95. If it works, your payout is significant, possibly, depending upon where you've managed to get your average price, possibly somewhere around about the 100 tick mark. Now, after you've got into a trade, you can also keep your options open in pyramiding a trade. Now this is even amongst traders here on the floor, this is a controversial, I think is perhaps one of the best ways of putting it, style and controversial sort of option that people take. Because this goes against the idea that if you have an optimal place to be in, adding afterwards is in fact a suboptimal trade. Because if you thought it was good to buy 50 and now it's trading 60, well, you're effectively missing 10 ticks. You're paying 10 ticks to get more onto the trade, which is not necessarily optimal. However, the counter argument to that is as confirmation increases, as information about the likelihood of your trade working increases, this justifies adding onto the trade. And what you're trying to do then is trying to maximize the trade whilst taking the minimal initial risk. So you take the trade on with a smaller position, and as you get more information that confirms you're right, adding on to the trade. Where I think it can be a negative is if you use the idea of pyramiding as a reason to justify not putting the size on early because you're trying to protect yourself. What I mean by that is if you're very confident on a trade, let's say you intend on putting 10 lots on the trade, you're extremely confident on this trade and you put 2 lots on the basis that you can add the rest on later so that you take a minimal risk to start with. That's understandable in some trades. But if you're doing that purely to circumvent taking risk all at once, what you're actually doing is increasing your risk because by adding on later on, you're shifting your average price and giving yourself essentially a larger risk on more size. So pyramiding has to be something that is planned in the sense of reactive to the way the market trades, that you're going to get in on a trade, and if it does certain things afterwards, then you're willing to pyramid, rather than saying, I want to get 10 lots in, but I'm going to start with 2 and pyramid up to 10. The idea should be, I'm going to get 2 lots in, and if I see this, this, and this, then I will use that as a reason to add on. So essentially what you're trying to do is you're trying to treat each entry as its own trade. And it's quite simply ask yourself, if you weren't already in a position, would you buy here if you were, say, long? And if the answer is no, then you don't add on to the trade. You can't pyramid at that point. And this is the danger. If your intent was to take a small risk early and pyramid up, you then end up adding on to the trade at points where probably you shouldn't really be taking trades on. But because your intent is already to increase the size up, rather than put it on where the payout and the position has the greatest conviction, you're then going to add it on at points that maybe don't have a great deal of clarity or value in being entered at those points. Excuse me. So how do you do it? Different methods to enter a trade. You can pyramid a reversal trade, and this again is something that I think people don't always think about. And I'll give you an example of this in a moment. What you can do as a way, and this I think is a good way of minimizing risk on a trade, using the action to give you information. So let's say, for example, you're going to try and buy this level. Now you could say to yourself, right, I'm going to buy 2 lots at the level. So the market comes down, trades through the level, and now back up. You haven't got stopped out on the trade. There's your stop, so you've not been stopped out. But now you've got new information. You're long, yes. You've gone offside and you're now back onside. This is a sign of rejection. The market is not happy down here, and so therefore, you now have a greater understanding that this can go up. The probabilities of this going up have now increased based on the new information. This can justify adding another 2, pyramiding your position when you come back on side, because the extra information that you've just gained suggests that you're more right than you were when you first put the trade on, and so therefore justifies a trade. Think of it from this point of view. If you didn't enter here, and you've seen a rejection, would you buy on the break on the move back above the level? Quite probably. So that then justifies 2 here and 2 here. So that's the way that you look into pyramidal reversal. This can be a way of saying, right, I want 4 on, but I'm going to enter 2 to make sure I'm in, and then I'm going to decide whether to add the other 2 based on what happens. If this goes 2 straight down to stop, you get stopped out on 2. If this goes 2 and bounces, doesn't stop you, and starts to trade back above the level, you can add back on. You've taken the risk, and now you're able to have more size on with greater conviction and greater confirmation of the trade. With a momentum-based trade, we're going to look more at this in terms of order flow as we go into order flow week, but I'll give you an early example in a moment. With a momentum-based trade, you're looking at each stage, each drive higher within the move. This is then a point where you can add on again. It's a case of using that volume at price concept. That's one way to pyramid a momentum trade. As long as that momentum is maintained, you can continue to leverage that position up. Again, this is not something that you have planned in terms of, right, I'm going to get 2 and then I'm going to add and add and add. This is a case where you say, right, I'm getting the trade on here, and then if I see this type of momentum, I'm going to add on, because I can define the risk on each add-on. That's the crucial element of pyramiding. It's having a pre-plan that if certain situations arise, if certain things happen, you can get in more. But if they don't happen, you're happy with the position that you already have. If you're not happy with the position you already have, you should have put more on to start with than try and add it on later on. That just goes to skew your average price, and you never really want to skew your average price in the direction of movement unnecessarily. Right, what we're going to look at here then is pyramiding after the execution zone. So what I'm going to show you is a little bit of both. We're going to see this execution zone trade. Now the execution zone runs from 96 to 99, so we'll let this start to trade out. So remember, we're looking to move into this zone above 96. So once you get above 96, that's the point where you're looking to try and enter. So we'll talk about specifics of order type entries as we go forward. We've got a stop entry here at 96. The idea behind this is the moment it ticks 96, we're going to add on, we're going to enter the trade. It's a bit of a preemptive trade, and does expose you to a risk that it hits 96 and rolls back again. We're not going to go into the details of the risk around using stop entries to get into a trade, but there we go. Stop entry into the trade. Now, within the execution zone, you can look to add on to the trade. Remember, the top of this zone is around 99. So what you're looking to try and do now is, as trade holds higher, if you look, each time it falls back, each time we get these little pullbacks, market's not holding on to a move lower. And as such, you can then add on to the trade. You see there, we trade back towards 96.5, volume starts to increase, we're starting to build volume up here. This is a good sign that you can add on to the trade. This is the scaling in phase here. So not a point where you're necessarily thinking, oh, yeah, I need to add and add and add. This would be a pre-planned element to the trade, that you've got a plan as to the size that you want to get in. You're going to get that size on in this zone. Once you break 99, then this becomes your area to pyramid. You may not get a chance. There may not be anything that allows you to pyramid. So we've got a position on already. It's average price around 96.5. What you're looking for then is, once we break 99, chances to add on to this trade. And this is all about pre-planning possibilities. So here we go, we're up towards 98 3/4. That little pop of energy, that little pop of momentum, that's again left a little pocket of low volume, is a chance to add on. And then we jump. Now as soon as we jump, this is now a chance first up to start to scale out of the trade. And that's a good indication of an exit. But now you see that we're starting to build that volume again at higher and higher prices. This is your chance to pyramid. You can add on, as we just see there, at around about 18.01. You've got the option, and you can leave these passive orders to try and get filled lower down at 00, back through those areas of low volume, like we talked about with volume and volume at price. This is volume at price building. Each time it does this, it's an indication of strength of movement. And as such, you can then add on as we start to build volume at higher and higher prices. So this is what I would call a passive continuation trade. We'll do more and more at this when we do order flow. But the simple idea behind it, you can't know where you can pyramid here. What you can know though, is what you want to see to pyramid. And what you want to see is these buildings of volume. As that volume builds up, you can add on to the trade. If you've got predefined targets, then once we start to move, you can start to exit the trade, scale out of that trade, as we've seen going on throughout the trade here. But once again, volume starts to build, you can add on once more. And with this, we just pyramided, added on once again there. If that doesn't work though, that pyramid has its own exit. 04.2, you take a 6-tick loss on that and you accept that, that's the loss, and that's okay. You can move on from the trade and you can then look at this and think, okay, right, well, is there an opportunity to pyramid further? Is there a chance to add anything more onto this trade? Do I need to be exiting? If you've got a target, then your target can stay as is, you can exit the trade. But as you see here, we've seen it fall back towards 04. You've now been given information that's showing you the market's starting to stall. We're building that volume up. 04.5, 04.2, this is the area down here where you can look to enter again. So you're using these builds of volume as methods to enter your trade, using that momentum, that continuous pace on the ladder, that continuous speed of flow of volume going through. That's this move here. As that's happening, you can add, because you're being shown information that says to you, people are buying, people are willing to trade at these prices, people are willing to keep buying here. As such, you can then keep on adding on to that trade. You don't get filled down there, you can then once more, same principle, start bringing your orders up here around about the 06 area, somewhere between 06 and 05.5. That could be your next area to try and add on to the trade. What that gives you, and just so you can see it up here, that's 06. The bottom of this little consolidation zone is 06. You will see volume build up in this zone here before yet another leg of continuation. And that's the idea behind this, that you're using this order flow momentum to pyramid the trade. You can't know what price is, you can't know where you're going to pyramid, but what you can know is what you want to see in order to do so, in order to pyramid this trade. You know what you're after. You can see these pockets of low volume, that's what you're after. You can also place your stop behind them. That gives you protection. You've now got a defined exit, which based on the initial entry down here, is pushing 90 ticks on side. And you've also got potential to add on. There was an opportunity to add on at 06 just there. With a defined stop of 10 ticks, you can hold that trade, continue to watch this market move towards the upside. So that's the idea. As long as that upside momentum is retained, as long as that buying pressure stays, it keeps seeing it fall back to 06 and it holds, as long as that stays there, this is all good. And you can keep this trade going, you can hold on to it until you get trailing stopped out or until you get a move up to any point where you have a defined target and exit the trade there. To give you a little illustration of what this looks like from the point of view of candlesticks, this is essentially the same concept, the same trade, opposite direction, it's not the same trade. But what you get in here then, this is a trade where you've got a head and shoulders pattern and you then get a breakdown. This is a failure, essentially, to break above a recent high. So you've got to break above 54.9. Fails to go higher, that's what creates the head and shoulders and we start to break down. So if you played the break of the head and shoulders, you don't know precisely where you can add on to this trade, but you do know what you want to see. What you want to see is this building of volume. Once that happens, you can use this zone to enter. Look at where that little range is being formed and enter there. Play for the next leg, same principle. Once you get the little low volume, you can then use that to give yourself a resistance, a stop, and continue to play the move down once more. Once you start to get this stabilization at lows, that's where you can give the trade up, that's where you can step away from the trade. So pyramiding using order flow or price action is very much a case of being able to look at something and have a pre-plan as to what you want to see to pyramid, not necessarily being able to define where precisely you're going to pyramid. It's about reacting to the information presented to you. Now, a passive pyramid is perhaps something that is a little bit more definable. With a passive pyramid, you already know where you can potentially add on to this trade. Using, for example, a block reversal. This is using a similar kind of concept to that reversal pyramid, if you will. That you can enter here, there's your initial entry on the block reversal, the breakout of the range. Now, you can plan very clearly here that if you get a pullback that starts to show signs of absorption down here, that holds the top of the block, then you can add on to this trade. And this is a mistake that so many people make. That what they will do is when we get back here, they'll scratch. They'll look at the trade and they'll think, oh, I went on side, I got myself 15 ticks on side, it's come back, I don't want to lose, scratch. Where in fact, the entry here is the confirmation that you're right. Coming back is saying to you, here's an opportunity, you're right, and now would you like to buy more? Whereas for so many people, the fear of losing after having been right means that rather than buying more, they actually sell at a point where you're being offered the chance to get in again on a trade that you've already been now shown is right. That's a much riskier trade. That may not work. But now you're in a situation where you've got a lot more information that suggests this probably will work. That's where you want to buy more. And it all comes back to this same question. If you didn't have a position, would you buy it here? And I'm pretty confident that many people would say, absolutely, I'd buy that. Simple passive entry trade. But once in, this changes people's perspective. This is why you have to consider a pyramid as a separate trade. And don't sort of take issue with pyramiding at the price you originally got on. If anything, that's better. Because now you're maintaining your average price low. If you buy here and buy here, your average price moves to there. Now all of a sudden, when it gets back, you're now offside at the point where you initially thought you were right. That's a worse situation. Whereas in this situation, you buy here and buy more here, you don't see yourself offside, you go onside now with double the position. So in that passive pyramiding, there's nothing wrong with pyramiding a trade at the price that you originally got into. It's still a pyramid as such. The pyramid is just increasing the size. You could call it leveraging your trade up, for want of a better word, rather than it necessarily having to be at higher prices if you're buying, lower prices if you're selling. This is something that you can do technically, and you can have pre-planned as to where exactly you're going to get in. You know that if you buy on the break here, that's your place to add. And as long as you get the absorption when you get back there, perfect, you can do that. You can also plan points to pyramid on a trade. And so what this is doing is this is predefining decision points for you. Now, this doesn't mean you must pyramid. What this means is that at certain points, if you have still got the right type of order flow, you've got the right type of movement that is matching your expectations, you can continue to add on to this trade. So if we look to start with on the left-hand example, what we've got here is a move in the S&P where we're looking for this potential move down to go and break through lows, taking us down towards 55. Now, you can look at this trade. You don't have to sell from the origin of this wash down, sell from up here. That's the easy way of looking at it and saying, oh yeah, of course you sell it up there, easy trade. Realistically, not the case. So you can look at this and you can say to yourself, okay, if we fall back through this zone here, the market's going to become bearish. I can have a go at selling. So you can sell it through 28. Now you can have this pre-planned already, that the next area of interest is 95. Dependent upon how the market trades, this is an opportunity to add on. But we could have a scenario where the market trades down here and does this. So what you're going to be looking for then is if this level breaks, that is a show not just that it's turned bearish, but there's a willingness to keep this move going. As such, you can pre-plan a passive entry at 95. Break the level, pull back, you're going to sell it. Wonderful. But now at this point, you're going to be much more bearish because you've had two tests of the bearish nature of the market, here and here. You're now feeling this is pretty bearish. As such, you can go for the more aggressive break of the lows. If you get down into this area here, 71, you can then try and play this through 71 to try and break the low. Because you've got that extra information, that extra confirmation that this move is on. So you've already pre-planned decision points. And you can pre-plan what you want to see at those points. So that when you get there, you can say, yep, this is what I'm after. This is good, I can take the trade on. Or you get there and you say, okay, this was a nice trade. We got down to 95, we bounced. That's it, we can give it up here. Decent move, you've got some money out of the trade, but it hasn't got the right criteria to go and break the next levels down. This is what happens. Then as you move through 28 to 16, this is on a 1 minute, boom, straight the way through it. I do apologise, it's not 1 minute, it's 5 minute. 5 minute, boom, straight the way through. So that gives you a reasonably strong little movement. So that's all good. So we can now start to have a go at selling this below 16. You get down towards 95. 95 is the point where this might not work. And you see there, we trade 95, up, back to it. Once you're through 95, then you can start to consider the passive entry. And this is the point of not pyramiding it straight away, because you do go through and pull back. Once through though, now you can have a go at the passive entry. You can be much more aggressive on the break of 71, which comes in here, because that's your kind of last point of resistance. And seeing as we've had a bearish move now, it's breaking back down through the range, you can be much more aggressive. Your intent is to go and break the low. So once you break the low, wonderful, trade is done. Smashes through the low through 55, little acceleration down, volume starts to drop off, exit the trade. All good, decent trade. But you've also now got new information, and you have the opportunity to then play the 55s, this low again, as a passive entry to try and play the next leg of the move down as well, which comes very, very quick into the close, gives you a 55 handle drop in the last 15 minutes of trade. Now, of course, you can't have known that was going to happen, but the fact is you could have pre-planned many of these entries on the way down, and so you could have extracted a significant amount out of the move by having pre-planned decision points, and then once you threw that previous low, selling 55s on a pullback based on the information you've already got, that this is clearly a rather bearish move, you can now play this once more, leg to the downside, and try and play the continuation of this movement.